As of early 2026, global public debt has crossed $110 trillion. The figure is so large that if you skim it, your brain will almost automatically file it under too big to matter. But don't rush past it. Keep one simple truth in view. This isn't the debt of someone somewhere. It's debt suspended over the entire economic system we live inside. The United States leads with roughly $38.3 trillion, close to a third of the world's total. China follows at $18.7 trillion, with debt accelerating sharply through 2025. Japan sits above $9.8 trillion, while the United Kingdom, France, and Italy trail behind. The paradox is hard to ignore. The richest and most powerful nations are also the biggest borrowers. Not because they're weak, but because they spend to keep the machine from ever being allowed to stop. Look at debt to GDP ratios and the story gets stranger. Japan carries something like 230–260% of GDP in public debt, among the highest on Earth. Yet society keeps functioning. Singapore's ratio can reach around 175%, but much of its debt is tied to investment and asset management through sovereign structures rather than day-to-day consumption. Then there are countries like Sudan, where debt above 220% of GDP meets political and economic instability, and there, debt stops being a policy tool and becomes a set of real chains. The lesson is uncomfortable but clarifying. Debt is not inherently good or bad. It's a knife. In steady hands, it's an instrument. In reckless hands, it's a disaster. And what's tragic is that ordinary people often recognize which one it is only after the consequences arrive. Higher inflation, cut benefits, lost jobs, or a whole generation paying for decisions it never truly consented to. The very idea of national public debt was born in war, not in peace. Long before modern Wall Street, parts of medieval Europe were already experimenting with state borrowing. Italian city-states, for instance, pushed the concept forward. Venice relied on forms of compulsory loans from wealthy citizens to finance conflict, then gradually turned temporary obligations into longer-lived claims that could be transferred, early DNA of a public bond market. But the turning point that made public debt into a true system, with norms, credibility, and the ability to scale, often gets linked to England's late 17th century financial revolution. In 1694, England helped create the Bank of England and secured foundational wartime financing in exchange for a stream of long-term interest backed by future taxation. That is the core of modern sovereign debt. The state converts credibility and the power to tax into a resource it can mobilize today. Put bluntly, public debt didn't originate as overspending. It emerged from power competition and then evolved into a tool of governance. From that moment on, public debt began shaping economies on two levels, one visible, one subtle. The visible layer is straightforward financing. Governments can fund wars, infrastructure, schools, healthcare, or emergency stimulus without immediately raising taxes to cover the full cost. In modern economies, that matters. Instead of letting downturns freefall and then improvising rescue efforts, the state can build a bridge across time, borrowing to carry the economy over the worst stretch and relying on future growth and future taxes to help pay the bill. But the subtle layer is where debt becomes both useful and dangerous. Debt is a long-term promise that ties the future to choices made today. As debt rises, interest costs start to behave like a fixed charge inside the budget. When interest rates climb, or when growth slows, those fixed costs swell, squeezing spending on productivity-building priorities such as education, infrastructure, and innovation. At that point, governments face hard options: raise taxes, cut spending, or rely, directly or indirectly, on monetary and financial mechanisms that expand liquidity. Every route has a price, and the bill rarely lands evenly across society. That's why, in highly developed economies like the United States, the United Kingdom, Japan, and China, public debt is unlikely to disappear in the clean personal loan sense of being paid off. Sovereign debt tends to live through rollover, issuing new debt to retire old debt, while keeping the system confident that the debt remains serviceable. The practical question is not, when will it be fully repaid? It's, can the country maintain enough trust and enough growth to carry the interest without triggering a crisis? The IMF has warned that spending pressures, slower growth, and geopolitical and trade strains can push global public debt higher again. potentially approaching or even exceeding 100% of global GDP toward the end of the decade, with adverse scenarios rising faster. In other words, the underlying trend is high and persistent, not temporary. The United States is the classic case of big debt still borrowable. By IMF-style measures, U.S. government debt relative to GDP sits at an elevated level. A realistic expectation is that U.S. debt will keep rising over time, pulled by three forces: aging demographics that expand entitlement costs, interest expenses that look structurally heavier now that rates are not ultra-low, and a persistent tendency toward structural deficits where recurring spending outpaces recurring revenue. America's advantage is immense: the dollar's global role, the world's deepest treasury market, and the safe asset status of U.S. government bonds. Those strengths allow the U.S. to roll debt longer and more smoothly than most countries can. But it isn't free. If confidence wobbles or inflation becomes entrenched, debt service costs become a budgetary pressure point, fast. The United Kingdom sits among the higher debt advanced economies as well, and its balancing act is familiar. Tighten too aggressively and growth stagnates. Loosen too freely, and markets demand a higher risk premium. The UK may not see debt accelerate in the dramatic US style, but it can still struggle to reduce the burden quickly if growth remains sluggish and fiscal space stays constrained. Japan remains the most famous paradox. Debt to GDP is exceptionally high, yet long-term yields have remained low for extended periods. The key lies in creditor structure and institutional design. A large share of Japanese government debt is held domestically, and the central bank's role helps stabilize the system in a closed-loop fashion. This makes high debt sustainable in a way that would break many other countries. But the trade-off is real: weak nominal growth, demographic headwinds, and long-run fragility if the underlying economic engine doesn't revive. China's situation is different again. Debt has risen quickly alongside repeated efforts to stabilize growth, and a meaningful portion of the burden sits in local government structures and related financing channels. The likely path is continued debt expansion, but with an emphasis on cleaning up and reshaping the structure, managing domestic financial risk, containing vulnerable nodes, and maintaining confidence in long-term growth capacity. For developing countries, public debt is a sharper two-edged sword because they often lack three advantages wealthy states enjoy: a reserve currency, deep and resilient capital markets, and institutional credibility strong enough to absorb shocks without breaking. The benefits are obvious. Debt can finance infrastructure, education, and healthcare, investments that raise future productivity. It can also smooth cycles when shocks hit: natural disasters, commodity price swings, pandemics. When borrowed well, matched to the right currency, the right maturity profile, and productive projects that expand the economic base, public debt becomes leverage for development. But the dangers arrive faster. Exchange rate risk can explode the burden if the country borrows in foreign currency and its local currency depreciates. Refinancing risk can become lethal when debt matures and markets refuse to roll it over or roll it only at punishing rates. And the political social costs can be severe when austerity becomes unavoidable. For many developing economies, a global rate shock or sudden capital outflow is all it takes for helpful debt to turn into strangling debt almost overnight. In the end, sovereign debt began as a survival strategy, war first, governance later, and became a permanent feature of modern economics rather than an exception. Its impact depends on a tight set of fundamentals: nominal growth, interest rates, institutional credibility, and the structure of creditors and borrowing currency. In rich countries, debt tends to remain high and is managed through credibility, markets, and central banking. In developing countries, debt can still be an opportunity, but only if fiscal discipline and investment quality are strong enough to convert borrowed money into repayment capacity. Otherwise, debt is not just a number. It becomes years traded away through higher taxes, lower public services, and a narrowed future that most people never see coming on the day the first loan is signed. And when people ask, "So who is the creditor?" they often point to China or the IMF. Reality is more layered. Germany has been described as the world's largest creditor nation thanks to persistent surpluses. Japan still holds vast net foreign assets. China is a major lender to many developing economies, including through less transparent channels. The IMF lends to dozens of countries, with large programs concentrated in a handful of borrowers. Yet the most stable, least discussed creditor is frequently a country's own people and domestic institutions. Government bonds sit inside pension funds, insurance portfolios, and banks, built from the savings of millions. In that sense, the world is in a state of mutual indebtedness. Big economies borrow heavily, lend heavily, and supply liquidity that keeps the financial system breathing. The response then is not panic and not faith in hollow slogans about erasing debt. The response is clarity, knowing where you stand inside this cycle. Because in a world that runs on financial trust, the person who understands the mechanism will always be harder to manipulate than the person who only feels the fear.